The one bank account mistake that disqualifies 99% of seniors from Medicaid. One tiny word on your bank statement can disqualify you from Medicaid even if your balance is low and you did nothing wrong. Banks encourage it, advisors miss it, and Medicaid reviewers flag it in seconds. The fix is simple once you know where to look. In this video, I'll show you how Medicaid really evaluates your money, control versus ownership, and how to protect cash legally without losing access. Grab your latest bank statement so you can follow along line by line. In a minute, I'll reveal the one label that quietly flips your account from safe to countable. Let's get into it. What Medicaid really checks: control versus ownership. Most people think Medicaid is only about how much money you own. That's why so many seniors get denied even when their balances look low. The thing most people miss is this: Medicaid cares about what's available to you, not just whose name sits on a line. If you can get the money today, they'll likely count it today. Let's translate that into plain English. Medicaid divides property into two big buckets: countable assets and exempt assets. Countable assets are things you could use for food, shelter, or cash right now: checking, savings, CDs, non-retirement brokerage accounts, and extra real estate. Exempt assets are things the rules let you keep without hurting eligibility, usually your primary home up to a limit, one vehicle of reasonable value, personal belongings, and properly structured burial funds. That core idea is consistent across states, even though limits and forms vary. Now here's the control test versus the title test. The title test asks, whose name is on the account? The control test asks, can the applicant access, spend, or direct this money? Medicaid reviewers lean on the control test. Why? Because if your name lets you withdraw funds, transfer online, or sign checks, the money is effectively available. Control beats title in most eligibility decisions. Let me give you common examples. A standard checking account in your sole name is countable, obvious. A savings account is countable, again obvious. A CD in your name is countable even if it has an early withdrawal penalty because you can still cash it, pay the fee, and use the funds. Compare that to your home. If it's your primary residence and you or your spouse intend to return, it's usually exempt up to an equity cap. One car used for transportation is typically exempt. Certain burial-related funds, like irrevocable funeral contracts or a separate burial account within your state's limit, can be exempt when labeled and documented correctly. Here's where people slip. A bank label or extra signer can shift control in a way that turns something safe into something countable, or turns something simple into a red flag. If an adult child is added in a way that lets you or them move money freely, Medicaid may treat the full balance as available to you, or view past transfers as gifts. If your account shows a label that implies the funds bypass your estate or change ownership at death, it still doesn't change present control. Medicaid focuses on what you can use now, not who inherits later. This clicked for me when I watched a reviewer ignore the headline "beneficiary designated" and go straight to, "Can the applicant access the cash today?" The answer was yes, countable. Let me show you exactly how to audit yourself in 60 seconds using 3 questions. 1. Could you right now withdraw funds, write a check, or move money without anyone's permission? If yes, it's likely countable. 2. Could someone else you added, like a child, do the same? If yes, be careful. Their access can create gift questions if money moved to benefit them. 3. Does the account label change who inherits but not how you use it today? If yes, Medicaid probably still counts it during eligibility. The reason this works is Medicaid's core principle: availability equals countability. Medicaid isn't punishing labels, they're preventing people from sheltering cash they can still spend. Once you frame it this way, decisions get easier. Here's a quick win you can do with that statement in your hand. Circle any accounts where anyone other than you can spend, withdraw, or transfer funds. Put a star next to any accounts with labels like POD, Todd, or ITF. Those labels don't protect eligibility, they just direct where money goes after you pass. Make a note to verify whether each account is single owner or has true transactional access for others. Common mistake to avoid: assuming small balances don't matter because you rarely use the account. Medicaid reviews the right to use, not your habit. Another mistake: thinking that because your child never touches it, their name won't matter. On paper, access exists, that can be enough. Once you nail this control versus ownership mindset, everything else clicks. Your job isn't to hide money, it's to set up accounts so you can pay bills while keeping eligibility rules on your side. Single-owner accounts paired with the right legal authority, like a properly drafted durable power of attorney, give you control and support without creating accountability landmines. And now, here's where most people mess up without realizing it. There's a single word that shows up on bank statements and signature cards that pushes reviewers to treat funds as available or to treat past movements as gifts. It looks harmless, banks recommend it to avoid probate, and advisors often shrug at it. But for Medicaid, it can flip the control test against you and trigger penalties later. Keep that statement handy. In the next section, we'll connect this control principle to the look-back rule so you see why even helpful labels and conveniences can blow up eligibility months or years down the line. The look-back rule without the legalese. Before we talk labels, you need one core rule in your head. Medicaid doesn't just look at what you have today. It looks backward to see what you did with money. That's the look back. If they find gifts, they can delay your eligibility with a penalty. It's not about punishing spending, it's about stopping people from moving money out of reach right before applying. Here's the plain version. Most states use a 5-year look-back for long-term care Medicaid. They review financial activity for the 60 months before you file. They're looking for uncompensated transfers, money or assets you gave away or sold for less than fair market value. If they find any, they total those amounts and divide by a state number called the penalty divisor, which represents the average monthly cost of nursing home care in that state. Let me strip the math down. Say your state's divisor is $8,000. If you gave away $24,000 within the 5-year window, Medicaid takes $24,000 divided by $8,000 and gets a 3-month penalty. That means you're otherwise eligible, but Medicaid won't pay for 3 months. You still owe the nursing home during that period. And here's a detail most people miss. In many states, that penalty doesn't start when you made the gift. It starts when you're in a Medicaid-certified facility, you meet the asset and income rules, and you've actually applied. That timing catches families off guard. Now you might be thinking, what about small transfers, birthday gifts, helping a grandchild? The mistake is assuming small equals invisible. It's not the size, it's the pattern and the documentation. A one-time $50 birthday check with a memo looks normal. Repeated round number withdrawals and transfers to family with no receipts look like gifts. Even worse, cash app payments to a child's account without an invoice look like you just moved money out. The reason this matters is simple. The look back is about intent and proof. If you can show the money paid for your expenses, care, medical, housing, utilities, taxes, legitimate debt, then it's not a gift. If someone else benefited and there's no clear reimbursement or contract, it risks being treated as a gift. Let me show you exactly how to build a clean paper trail. Start with memos. Put clear, specific purposes on checks and electronic transfers. Home care 20 HRS at 22/HR week of May 1, wheelchair ramp materials, cardiologist copay, property tax Q2. Then match each payment with a receipt, invoice, or contract. Keep caregiver logs if you're paying a helper. And if you reimburse a family member for buying supplies, pay them back with a check titled Reimbursement, Receipt 1143 attached, and staple the receipt to a copy of the check. That pairing kills the gift assumption. Now here's where most people mess up. They think only moving money to someone else triggers a penalty. But the look back also flags when you transfer assets for less than they're worth. Selling a car to a nephew for $1, that's likely a gift of the difference. Transferring your home to a child without a permitted exception, that's usually a gift too. There are exceptions like a spouse, a disabled child, or the caretaker child exception for a child who lived with you and provided care that delayed nursing home placement. But you need to prove those with records, not stories. Quick win you can do today. Scroll your last 12 months of statements and list anything that's a transfer to a person, a round cash withdrawal, or a cash app payment. Next to each, write proof. If you can't pull a receipt, invoice, or contract within 5 minutes, put it on a fix list. For legitimate expenses, gather documents and label them. For fuzzy items, ask for copies of receipts or create a reimbursement note and supporting record now. You're building the binder that saves you later. One more timing point. If you made an actual gift inside the 5-year window, you can often cure it by getting the money back. Even partial returns can reduce the penalty because Medicaid recalculates the transfer amount. Don't wait until you file to sort this out. The earlier you document and reverse what you can, the cleaner your eligibility path. So remember, the look back targets gifting and undervalued transfers. It's not about your normal spending, it's about who benefited and whether you can prove it. In the next section, you'll see why a for convenience joint account turns ordinary spending into a trail that looks like gifts. The joint account trap, JTWROS explained. Now here's where most people mess up. You add someone for convenience, and you've quietly created a countable asset minefield. The label is joint tenants with right of survivorship, JTWROS. Banks love it because it's easy and avoids probate. But for Medicaid, it often means 100% of that balance is treated as yours if you're the applicant, because you still have full access and control. Let's break what JTWROS really means. On paper, both owners have equal immediate authority to withdraw, transfer, and spend the entire balance. If you walk in and pull every dollar, the bank won't stop you. That's the control test in action. If you can access it, Medicaid can count it. And because you're the one applying, reviewers often treat the whole pot as available to you, not 50-50 and not just your portion. The thing most people miss is the survivorship part only decides who gets the money after someone dies. It does not change present control. Right now, both parties can spend it. So from Medicaid's view, the money is available to you today. Availability equals countability. Common myths get people in trouble. Myth 1, it's 50-50. Not for eligibility. For taxes or internal family tracking, you might think halves, but Medicaid looks at ownership and access, not your private agreement. Myth 2, it protects from probate, so it protects from Medicaid. Avoiding probate is an inheritance shortcut, not an eligibility shield. Myth 3, it's safer because my child can help pay bills. Safer from missed payments, maybe, but riskier for eligibility and for look-back issues if money moves to benefit the child. Let me show you exactly how this plays out. Example 1, an adult child is added to mom's account for convenience. Child uses the account to pay mom's utilities, fine if documented, but then the child also pays their own car insurance from that account just once. To Medicaid, that's mom's money benefiting someone else. It looks like a gift. Without receipts and a reimbursement back to the account, you've got a problem. And because both parties had full access, it's easy for a reviewer to treat a string of those payments as uncompensated transfers. Example 2, spouse-only joint accounts. Between spouses, the whole balance is counted during the resource assessment in most states. After that assessment, rules allow a protected amount for the community spouse, but during the look-back and eligibility review, the starting point is that spousal assets are available. A joint label doesn't reduce what's counted, it just places both names on the funds. Example 3, siblings. A sister adds her brother as a joint owner to help out. He moves money between accounts to reimburse himself for errands, gas, and groceries, but there are no logs, memos, or receipts. Those transfers look like gifts unless he can prove the purchases were for the sister's benefit and at fair value. A quick reimbursement note and attached receipts would have changed the picture. The game changer nobody talks about is this: even if the other person never touched the account, your ability to use 100% of the funds is enough to make it countable. Reviewers care about what could happen, not just what did happen. That's why they never use it isn't a defense. So what should you do instead? Use alternatives that keep help in place without creating joint ownership. Properly drafted durable power of attorney lets your chosen agent pay bills from your single owner account. Online banking with view-only access and bill pay keeps control with you while giving helpers visibility. You can also add your child as an authorized signer on specific checks through your bank's bill pay tools without making them an owner. These methods allow help without handing over full present ownership. Let me give you a quick win you can implement today. Open your statement and look at the ownership line. If you see JTWROS, joint or multiple owners, list that account for restructuring. Next, scan the transactions for anything that benefited someone other than the applicant. Cash App transfers to a child, payments to a child's mortgage, Venmo for family, groceries with no receipt. For each, collect documentation and create a reimbursement if appropriate with a clear memo. That paper trail can cure the gift presumption. Watch out for this subtle trap: moving money from a joint account into the child's personal account to keep it safe. That's a transfer out of the applicant's control. Without a documented reason tied to the applicant's expenses, it lands as a gift. If the funds truly were for the applicant's benefit, the fix is to reimburse the joint account from the child's account, attach receipts, and label the memo clearly. One more nuance. Sometimes banks set up a convenience account or make a person an authorized signer. That sounds safer, but you need to confirm in writing that the signer is not an owner and has no survivorship rights. Even then, if the signer pays their own bills from your funds, it still creates a gift issue. Authority to transact doesn't make improper spending okay, only proper documentation and purpose do. If you remember nothing else about joint accounts, remember this: joint equals present access equals countable, countable plus sloppy spending equals look-back trouble. The clean path is single-owner structure plus legal authority, with every payment tied to a real expense for the applicant and backed by receipts. Gifts, reimbursements, and the who benefited test. Here's the part that surprises people. Even if you avoid joint ownership, spending patterns can still look like gifts. Reviewers apply a simple lens: who benefited. If the primary benefit went to someone other than the applicant and there's no clear exchange for value, they'll flag it as an uncompensated transfer. That's the who benefited test, and it's how ordinary payments can turn into penalty months. Let's make it practical. Start with reimbursements. Reimbursements are fine when they're clean. Clean means three things line up: the purchase was for the applicant, the amount equals the documented cost, and the record connects the dots: receipt, invoice, check, or transfer memo. If your daughter buys incontinence supplies on her card and you reimburse her, that's not a gift when the memo says reimbursement, supplies 612, CVS receipt 1143, and the receipt is attached in your binder. Same rule if she pays a home care invoice and you pay her back for that exact invoice. Now here's where most people mess up. They use cash or round number transfers with no paper. A $500 ATM withdrawal every month with no receipts looks like gifting. A $1,000 Zelle to a son for groceries with no itemized list looks like gifting. Venmo with a pizza emoji is not documentation. If the reviewer can't see the expense trail, they assume benefit went to someone else. The thing most people miss is proportionality. If your utility bill is $130 but you transfer $300 to a child to cover bills, Medicaid doesn't infer the leftover went to you. They infer you gave away the difference. That's why exact amounts and memos matter. When the numbers match, it reads as payment. When they don't, it reads as transfer. Let me show you exactly how to handle common scenarios. Paying a child's mortgage because they take care of me. That's a gift unless there's a written caregiver agreement and logs showing care hours at a reasonable rate. Better path: pay the child for documented care time, then let them use their income for their mortgage. Paying a grandchild's tuition, that's a gift. Buying equipment that keeps you safe at home: grab bars, shower chair, bed rails, clearly your benefit, not a gift. Funding home modifications like a ramp or wider doorway, your benefit. The memo should say home accessibility ramp install, invoice 2217. What about temporary loans? Verbal loans with family are treated like gifts unless there's a signed promissory note with terms that meet your state's rules: fixed interest, equal payments, no balloon, and an amortization schedule. Even then, the payments must actually come back through your account. If nothing's coming back, it wasn't a loan, it was a transfer. Cash apps need discipline. If you use Zelle, Venmo, or PayPal, use the note field like a mini invoice. Reimbursement RX copays May 3 receipts, caregiving 10 HRS at $22, week of 5/15, care log P3, grocery delivery, itemized receipt attached. Screenshot the receipt and store it in your digital folder with the transaction confirmation. Without that, those apps are red flags. Here's a quick win you can do today. Build a reimbursement log, a simple sheet or spreadsheet with 5 columns: date, payee, purpose, amount, proof. Each time money leaves your account to a person, fill all 5. Proof cannot be texted me, it's a receipt, invoice, contract, or care log. Pair that with memo discipline. Every check or transfer gets a specific memo that matches a document in your binder. A few common mistakes to avoid. Paying a family cell plan from your account when you're one line on the bill, split it precisely and memo your share. Buying gas for a child's car because they drive you, acceptable only if the mileage ties to your appointments. Better yet, reimburse mileage at a set rate with a log. Giving cash to a neighbor who shops for me. That's a gift unless you convert it to reimbursements with receipts or pay a delivery service directly. If you remember nothing else about the who benefited test, remember this: tie every dollar to your need, match amounts to documents, and label everything like a reviewer is reading it cold. When benefit, amount, and proof align, it's spending. When they don't, it looks like gifting. Todd ITF, the labels that trigger denials. Let's talk about the labels banks love to add: POD, TOD, and ITF. They sound harmless: payable on death, transfer on death, and trust for. Banks pitch them as a simple way to avoid probate. That part can be true for inheritance. But for Medicaid eligibility, these labels do not shield the money because they don't change present control. If you can access the funds today, they're countable today, no matter who's listed as beneficiary tomorrow. Here's the thing most people miss. Beneficiary designations are about who gets the money after you die. Medicaid is about whether you can use the money while you're alive. A POD or TOD label gives your beneficiary zero access right now. You still control every dollar. That's why reviewers see a POD checking account exactly like a regular checking account during eligibility. It's still available to you, so it's countable. Now, ITF confuses people. ITF does not create a protected trust for Medicaid purposes. It's a bank titling shorthand that means the account is held in trust for a named beneficiary, but you retain full control and can change or remove the beneficiary anytime. That's not an irrevocable trust. It's basically a pay-on-death setup with a different label. Because the money is under your control, Medicaid counts it. Let me show you how this plays out. Example 1, your savings account says Jane Doe POD, Mark Doe. You can withdraw the entire balance today. Medicaid counts the balance. The POD only matters after you're gone, and even then, estate recovery rules can still come into play depending on your state and estate structure. But for eligibility, POD offers no protection. Example 2, your CD is titled John Smith ITF, Lisa Smith. You can break the CD, pay a penalty, and use the cash. That makes it available now. Medicaid counts it. The ITF label doesn't change the availability test. Example 3, Todd on a brokerage account. Transfer on death means your beneficiary inherits the account outside probate, but as long as you can sell shares and withdraw cash, Medicaid treats that balance as countable. Again, who inherits later is irrelevant to present availability. Common confusion crops up when people mix these with other beneficiary setups. A revocable living trust with you as grantor typically leaves assets available to you, which means countable. An irrevocable trust can work only if drafted so you can't get principal back and state rules recognize it as unavailable. That's legal drafting territory, not a bank card label. And beneficiary IRAs are a different category. Retirement accounts can be treated differently by state and program. Some count value with required distributions, some focus on payout income. But simply naming a beneficiary on a bank account doesn't convert it into a protected bucket. Now here's where people get burned. A banker suggests, add a TOD so it bypasses probate, it's cleaner. You nod, thinking you just protected the money. Then you apply for Medicaid, the reviewer pulls your statement, sees you have full access, and counts the entire balance. Nothing about TOD stopped that. Worse, if you also had informal transfers to the beneficiary, those can look like gifts during the look back. So how should you use these labels? Use them strategically for estate administration, keeping small accounts out of probate, while understanding they don't help eligibility. If Medicaid is in your near future, prioritize eligibility first, then decide whether a beneficiary designation still serves a purpose without creating confusion. Here's a quick win you can do in 5 minutes. On each statement, highlight any account title that includes POD, TOD, or ITF. Next to each, write eligibility, countable so you don't fool yourself into thinking it's protected. Then review payable on death beneficiaries to ensure they match your current wishes, knowing they don't change eligibility. If you have large balances that need protection, talk with an elder law attorney about options that actually change availability, like properly drafted irrevocable arrangements started outside the look back, or spending down into exempt categories. One more nuance, a POD-TOD can inadvertently complicate record keeping. If a beneficiary occasionally uses your card or you move funds to them so it goes where it should, those patterns read as gifts. The safer route is to keep a clean single-owner account, stop transfers that benefit others, and document any reimbursements precisely. If you remember nothing else about these labels, remember this: POD, TOD, and ITF solve probate, not Medicaid. Reviewers ask one question: can you touch the money today? If yes, it's countable. Keep your estate plan tidy, but don't mistake a beneficiary line for eligibility protection. The real protection comes from structure, documentation, and spending that clearly serves your needs while you're alive. Safe harbor structures that don't blow eligibility. You need a way to pay bills, manage deposits, and get help without turning your accounts into landmines. The safe harbor is simple: single-owner accounts for the applicant plus the right legal tool that lets a helper act without becoming an owner. When structure is clean, reviewers stop hunting for gifts and start nodding yes. Start with the cornerstone, a properly drafted durable power of attorney. Durable means it keeps working if you become incapacitated. Read the document, don't assume. You're looking for explicit authority to handle banking, open and close accounts, use online bill pay, access safe deposit boxes, deal with government benefits, and if appropriate, make limited gifts within Medicaid rules. If your POA is springing, it activates only when a doctor certifies incapacity. That can delay help at the worst time. A durable, immediately effective POA avoids that bottleneck, assuming you trust your agent. Here's the thing most people miss. Gifting authority inside a POA can be a double-edged sword. It's useful for tax planning or certain Medicaid strategies with attorney guidance, but it can also create look-back problems if a well-meaning child starts moving money. Best practice is clear limits. The POA can authorize gifts only with written direction from you or counsel, and only if consistent with Medicaid rules. That way, the agent can act when needed without freelancing. Now pair that POA with a single-owner checking account that runs all regular expenses. Your Social Security, pension, and other income can deposit there. Your agent can pay bills through bank bill pay, mail checks, or manage auto drafts. Because you remain the sole owner, the account is clearly yours for eligibility, and there's no second owner creating gift optics. Add transaction alerts to both you and your agent, texts for withdrawals over a set amount, email alerts for new payees, and daily balance summaries. Visibility prevents mistakes and proves you're on top of things. For Social Security specifically, you have another safe option, a representative payee account. If you can't manage benefits yourself, Social Security can appoint a payee. The funds must go into an account titled for your benefit, not jointly owned. The rep payee has strict rules and record-keeping, which reviewers respect. Keep Social Security funds in their own account if you go the payee route. It makes auditing easy and clean. Let's talk burial funds. Done right, burial accounts and irrevocable funeral contracts are exempt. The catch is done right. Your state likely has a dollar cap on a dedicated burial account. The title should be clear, often burial fund for name, and you shouldn't mix other spending in that account. Irrevocable funeral contracts prearranged with a funeral home are typically exempt when compliant with state rules. Keep the contract and proof of funding in your binder. Reviewers look for clarity, irrevocable, itemized, and within limits. What about savings? Keep it single owner too. If you need a helper to move cash for you, the POA covers that. Resist the urge to add joint names just in case. If multiple people help, consider giving view-only access to more than one person while keeping transaction power with your primary agent. Many banks can set read-only online credentials so children can monitor without touching the money. A quick note on retirement accounts. Treatment varies by state and program, but the safe approach remains the same: no joint owners. Keep withdrawals and required distributions documented and route them through your single-owner operating account. Memo the purpose of any extra distributions so it's obvious they support your care or living costs. Here's your practical setup checklist you can complete in an afternoon. 1. Review your POA. If it's outdated, springing without reason, or missing banking and government benefits powers, schedule an update with an elder law attorney. 2. Consolidate routine expenses into one single-owner checking account with online bill pay. Turn on alerts. 3. Set up view-only access for watchers, not doers. 4. If Social Security needs oversight, ask about a representative payee and open a separate payee account titled correctly. 5. Create or verify your burial plan dedicated account within limits or an irrevocable funeral contract with documents filed in your binder. A few pitfalls to avoid. Don't name your agent as a joint owner to make it easier. That undoes the whole point. Don't rely on shared credit cards. Authorized user status can still blur who benefited. Keep receipts for everything paid to a person, and don't give your PIN to anyone. If an agent needs card access, many banks can issue a separate debit card tied to the same account with spending limits and alerts. That keeps authority tracked while avoiding joint ownership. The payoff is real. With this safe harbor, you can pay every bill on time, your helper can step in instantly, and Medicaid reviewers see clean lines, single-owner control, proper authority, and records that match. That's how you keep eligibility intact while living your life. Documentation that saves you in a review. Paperwork is the difference between approved and denied, even though everything was legitimate. Reviewers don't guess. They match transactions to documents. If your records tell a clean story, who got paid for what and when you glide through. If they can't connect the dots, they assume the worst: gifts, hidden control, or non-allowable spending. Here's the simple goal: make a stranger understand every dollar in or out without calling you. That means 3 layers of proof line up: bank statement entry, memo or note, and an external document like a receipt, invoice, contract, or care log. When those 3 align, questions disappear. Start with the core stack you need ready. Bank statements for all accounts in the look-back period. Copies of checks front and back, or images from online banking. Bill pay confirmations or ACH details showing who was paid and why. Receipts and invoices for purchases. Signed care contracts if you pay family or private caregivers. Mileage logs for medical trips if you reimburse drivers. Equipment orders and installation invoices for home safety items. Property tax bills, insurance declarations, and utility statements. If Social Security has a representative payee, keep annual accounting forms and the dedicated payee account statements. Now build a monthly reconciliation routine that takes 15 minutes and saves months of stress later. Each month, pull the statement. Scan down the list and mark every payment to a person, any cash withdrawal, any transfer to a non-bill pay recipient, and every Cash App transaction. For each mark, staple or digitally link the matching proof, a receipt, invoice, or contract. If it's a reimbursement, write reimburse, the date, and the receipt number on the statement next to the transaction. If it's caregiving, attach the care log with hours and rate that match the payment. Let me show you a quick checklist you can run every month. 1. Statements downloaded and saved with consistent file names, YYYYMM account name. 2. All checks to people have memos that state purpose and period covered. 3. Every Cash App payment has a descriptive note and a screenshot of the receipt filed with it. 4. Cash withdrawals have itemized receipts that total to the withdrawal. If not, reduce cash use and switch to check or card for clearer trails. 5. Any large or unusual item has a 1-line explanation sheet clipped to it. Wheelchair ramp, invoice 2217, medically necessary for home safety. There are red flag keywords that trip reviewers. Avoid writing gift, allowance, loan, or help in memos unless there's a compliant loan document or care agreement attached. Replace vague with specific. Caregiving 12 HRS at 22/HR6/56/7. Reimbursement for RX receipts 310-314. Dental Crown Dr. Patelin 5849. Property tax Q2 2025. Specific reads as fair market value payment. Vague reads as transfer. Care contracts deserve a moment. If you pay a family member for care, use a written agreement that sets rate, tasks, schedule, and how payment occurs. Rates should match local market rates. Keep weekly logs signed by the caregiver. Pay by check from your single-owner account with matching memos. This is how you convert looks like a gift into documented service at fair value. Receipts and invoices need to be legible and match amounts. If you're missing one, call the provider and ask for a duplicate. For online purchases, print order confirmations and delivery receipts. For recurring bills, keep the annual statement or policy documents so amounts make sense to a reviewer. Create 2 homes for your records, a physical binder and a mirrored digital folder. The binder tabs: statements, checks, ACH, care contracts and logs, medical and RX, home safety and repairs, transportation mileage, taxes and insurance, burial and funeral, Social Security rep Payee. The digital version mirrors those tabs with scanned PDFs. Name files to match statements and receipts. If someone helps you, share the digital folder with view access so they can add proofs. Common mistakes to avoid. Round number cash withdrawals with no receipts, these scream gifting. Fix by reducing cash and using check or card with itemized receipts. Writing for family help in memos, translate help into a care log and a rate. Backdating agreements don't. Sign care contracts before work starts or at worst from a current date forward. Paying multiple family members without separate logs, use one agreement per caregiver with their own logs. Mixing Social Security rep payee funds with other money. Keep a separate account if you're a rep payee and file the required SSA records. Here's a quick win you can do today. Start a Medicaid-Ready binder and digital folder. Print your last 3 months of statements. Circle every person-to-person payment, cash withdrawal, and Cash App transfer. For each circle, attach proof or create a 1-page explanation with a plan to fix missing documentation within 7 days. Turn on bank settings to save check images automatically and download statements monthly. One more pro tip, write a one-page cover note each month. June, increased pharmacy costs due to new prescription, hired caregiver 10 HRS/week installed grab bars. When a reviewer sees that note, they understand the pattern before they question it. Clear story, clear approval. Undoing mistakes, inside versus outside the 5-year window. Let's fix problems, not panic. The playbook changes based on timing, inside the 5-year look-back versus outside it. Get this right and you turn "uh-oh" into approved. Inside the look-back, your goal is cure, document, and recalc. A cure means reversing or offsetting the transfer. If you gave $10,000 to a child 18 months ago, ask for the money back. When funds return to your account, you've cured the gift. Medicaid will reduce or eliminate the penalty because the uncompensated amount shrank. Even a partial return helps. If $6,000 comes back, the gift is now $4,000 and the penalty is recalculated off that lower number. If the recipient can't return cash, a documented exchange for value can still help. Example, your son can't repay $3,000, but he can provide 150 hours of care at $20 an hour under a written agreement going forward. You can't backdate, but you can stop the bleeding and prevent new issues by formalizing care now. For the original transfer, provide a hardship explanation if repayment is impossible and immediate care costs would cause deprivation. Hardship waivers are tough, but not impossible with strong proof, facility invoices, your income limits, and a statement from the recipient explaining why repayment can't happen. Now the cure only works if you document it like a reviewer would. You need bank proof of the original transfer, a written request for return, bank proof of money coming back, and a short memo that ties them together. Gift returned reduces transfer dated 3/12. Keep emails or letters from the recipient acknowledging the return. If you're doing a partial cure, show the math. Original $12,000, $5,000 returned, uncompensated balance $7,000. Another inside window tool is converting an improper pattern into a proper one going forward. If you paid a child irregularly with no logs, stop that. Draft a caregiver agreement at market rate, keep timesheets, and pay by check with matching memos. This won't erase past transfers, but it prevents new penalty months from stacking up while you resolve the old ones. If a home transfer happened within the window without an exception, talk to counsel immediately. Sometimes you can deed it back to cure, recognizing tax and title costs. If the caretaker-child exception might apply, gather evidence now. Physician letters, care notes, calendars showing the child lived with you and provided care that delayed facility placement for at least 2 years. The difference between story and records is approval. Outside the 5-year window, the mission is cleanup and clarity. Transfers older than 5 years are generally irrelevant for current eligibility, but messy titles still cause confusion. Retitle risky accounts to single owner. Remove joint owners who were added for convenience. Close dormant accounts with odd labels like ITF if they're not serving a purpose. You're rebuilding a clean, simple picture that reviewers can scan in minutes. Here's a practical sequence for outside window cleanup. 1. List all accounts with owners and labels. 2. Convert joint accounts to single owner. If someone needs access, use your durable POA and set up bill pay. 3. Separate Social Security into a dedicated Rep Payee account if appropriate. 4. Verify burial accounts and irrevocable funeral contracts meet your state's requirements and are labeled correctly. 5. Turn off Cash App shortcuts for person-to-person transfers unless you attach documentation every time. Don't overlook CDs and brokerage. If you can liquidate with a modest penalty and reposition into exempt or compliant structures, do it early. If you're keeping investments, maintain them in your sole name and route distributions into your operating account with clear memos. RX annual deductible, dental work, home safety upgrades. The thing most people miss is that partial cures still reduce penalties. If you can only claw back half, it's still worth it. Medicaid math is straight division. Shrinking the transfer shrinks the penalty months. That's real money saved on the facility bill during the penalty period. Let me give you a 30-day cleanup plan you can start today. Week 1. Identify transfers in the last 5 years that benefited others. Make a return request list with dates and amounts. Send written requests and set a 14-day target. Week 2. Restructure accounts, remove joint owners, enable POA access, set alerts, and open or verify burial rep payee accounts. Week 3. Build your documentation binder and digital mirror. Attach receipts to any flagged transactions from the last 12 months. Create caregiver agreements and logs if care is ongoing. Week 4. Process returns you received, deposit them, and label deposits as return of prior transfer cures. For amounts not returned, write a brief explanation sheet and, if appropriate, prepare a hardship packet with facility statements and your income details. One warning: avoid last-minute flurries right before filing. Reviewers notice sudden mass changes. Start early, make steady fixes, and let 1 or 2 clean statement cycles roll by. Consistency buys credibility. If you remember nothing else here, remember this: inside the window, cure and document; outside the window, simplify and align. Either way, your goal is the same: make the money trail show that your funds serve your care, not someone else's wallet. Spend down strategies that actually help you. After cleanup, the smartest move is turning countable dollars into things that improve your care and stay exempt. Spend down isn't random shopping. It's targeted conversion: cash to care, cash to safety, cash to medically necessary items, and cash to legitimate debt. Do that, and you reduce assets while raising your quality of life. Start with home safety and accessibility. These are powerful because they directly support your ability to remain at home and reduce future facility costs. Think grab bars, shower chairs, handheld shower heads, raised toilet seats, non-slip flooring, brighter task lighting, smart fall detection devices, bed rails, and hospital beds prescribed by a physician. Bigger projects can qualify too: doorway widening, threshold removal, interior ramps, stair lifts, and bathroom conversions for walk-in showers. The key is documentation: invoice, proof of install, and a short note tying it to safety or mobility. If a doctor will write a recommendation for the modification, even better. That note lives in your binder next to the invoice. Next, medical and dental. Finish the dental crown, get the hearing aids, update eyeglasses, replace dentures, schedule the podiatry work, and buy the durable medical equipment you actually need. Hearing aids and dental are notorious for being delayed. Use spend down to get them done now. For recurring medical, prepay known out-of-pocket costs or annual deductibles to providers where allowed and receipted clearly. Keep itemized statements and receipts. Care is a big category. You can pay for private home care hours at market rates, respite care, adult day services, or care management. If family provides care, use a written caregiver agreement with a fair hourly rate and logs. Pay by check with matching memos. These payments reduce countable assets while directly supporting your health. If you're approaching nursing home eligibility, paying for a short private pay period while you finish documentation can also be strategic. Debt reduction helps too. Pay down or pay off legitimate debts: credit cards, medical bills, tax liabilities, and home-related arrears. Stick to debts in your name. Paying a child's debt is a gift. Paying your visa with medical charges is spend down. Request final statements and keep the zero balance letter. Your vehicle is usually exempt. Use that to your advantage. You can repair, replace, or upgrade to a safe, reliable car used for your transportation. New tires, brake work, major service, adaptive driving controls, a safer vehicle with higher seating for transfers — these are valid. Title in your name, pay from your account, keep the bill of sale and maintenance invoices. Prepaid burial and funeral are classic spend downs when structured correctly. Fund an irrevocable funeral contract within your state's limits with an itemized statement. If your state allows a separate burial account, top it up to the permitted cap and label it clearly. Add burial space items if allowed: plot, vault, marker, opening, closing fees. File every document and proof of payment. Home maintenance that preserves safety and habitability counts. Roof repair to stop leaks, HVAC service or replacement, water heater, electrical fixes, and accessibility-friendly flooring are reasonable. Cosmetic upgrades don't help, hazard removal does. Tie each invoice to a safety or functional reason. A few things to avoid: don't prepay rent to family or hand them lump sums for future care. That looks like gifting. Don't buy collectibles, gift cards, or luxury items. Don't loan money to relatives, and don't overpay for services above market rates. Reviewers know local costs. Keep everything arm's length and documented. Let me show you how to convert cash into exempt value cleanly. Step 1. Make a needs list: safety, medical, mobility, care, debts. Step 2. Price each item with quotes or invoices. Step 3. Prioritize by impact on daily living and risk reduction. Step 4. Schedule purchases and installations over a couple of statement cycles so the paper trail is clear, not chaotic. Step 5. Pay providers directly from your single owner account with specific memos, then file the receipts. Here's a practical example. You have $18,000 to spend down. Allocate $6,500 to hearing aids and dental work with itemized invoices. Allocate $4,200 for a stair lift and grab bars. Keep the doctor's note recommending fall prevention. Allocate $3,600 to 6 weeks of documented home care at $20 an hour, 30 hours per week with logs. Allocate $2,200 to replace bald tires, brakes, and do a full vehicle service. Allocate $1,500 to zero out a medical credit card. That's $18,000 moved into exempt or care categories with airtight documentation and real-life benefits. Common mistakes: vague invoices like housework, cash payments with no receipts, and paying family informally for help. Replace those with vendor invoices, card or check payments, and formal caregiver agreements. Another mistake is waiting too long and trying to do everything in one frantic week. Spread it across a month or two with clean records. Quick win: use our caregiver agreement template and hourly logs. Set a fair rate, define tasks, and start logging hours today. Pay weekly or bi-weekly with memos like Caregiving 15 HRS at 22/HR 7/17/7 log P2. That single change turns a red flag pattern into compliant spend down that supports eligibility in your care. Nursing home, assisted living, and waivers, different rules. Before you move a dollar, you need to match your plan to the right Medicaid program. Nursing homes, assisted living, and in-home care waivers share the Medicaid name, but they run on different eligibility engines. Mixing rules is how people get denied after doing months of work. Start with the nursing home program, often called institutional Medicaid. This program covers long-term care in a Medicaid-certified facility. Asset rules follow what we've been teaching: countable versus exempt, 5-year look back, and strict documentation. The income side is simpler structurally but tougher emotionally. Once approved, most of your monthly income goes to the facility as your patient pay amount, also called the cost share. Medicaid then pays the rest of the facility's rate. You keep only small personal needs money each month. Think a modest allowance for essentials and certain insurance premiums. If you have a spouse at home, we'll get to protections for them soon, but the big picture is this: the nursing home program is strict, predictable, and paperwork heavy, and it expects your income to help cover care. Now let's separate that from HCBS waivers, home and community-based services. These waivers try to keep you at home or in community settings by paying for services like personal care, adult day, respite, or even some assisted living in certain states. Here's the twist: many waiver programs use an income cap, often a hard monthly number. If your gross monthly income is above that cap, you're not out of luck, but you need a qualified income trust, also called a Miller Trust, where allowed. The QIT is a simple pipeline. Your income flows into the trust account each month, then out to approved expenses and your cost share. Set it up wrong, deposit inconsistently, or miss required language, and eligibility can fail for technical reasons even when your assets are perfect. Assisted living creates the most confusion because families assume Medicaid will pay for the apartment. In many states, there isn't a standard Medicaid entitlement for assisted living room and board. Some states have specific assisted living waiver slots, but they're limited and often waitlisted. Even when covered, Medicaid typically pays for care services, not rent. That means you still need income to cover room and board, and the program may cap what it pays providers. The eligibility criteria might mirror waiver rules, income caps, and QITs, plus the same asset and look-back framework. The mistake is moving into a facility on the promise of "we take Medicaid," without confirming whether your state's program actually funds that level of care and whether a waiver slot is available when you need it. Let me make the income rules practical. If your state has an income cap and your gross monthly income is even $1 over, you likely need a QIT. The trust must be irrevocable, use the state's required wording, have a dedicated bank account, and receive the right sources of income every month, no skipping. Deposits must happen in the month the income is received. Advisors often miss the timing detail and families lose a month of eligibility. The clean path is to open the QIT account early, set automatic deposits for the pension or Social Security, and keep the statements in your binder with the trust document. Here's where most people mess up with program differences. They apply with documents named for the nursing home program while seeking a waiver, or they budget as if waiver services cover 24/7 care. Waivers generally cap hours based on assessment. They don't fund full-time private duty. If you need more hours than the waiver authorizes, you'll still have a private pay gap. Plan for that gap before you rely on a waiver to keep you at home. A quick win you can do this week: build a program checklist for your state. Call your area agency on aging or state Medicaid helpline and ask 4 questions. 1. For nursing home Medicaid, what's the current resource limit and personal needs allowance? 2. For HCBS waivers, is there an income cap and do you require a QIT? 3. Does your state fund assisted living through a waiver and are there wait lists? 4. What documentation is required for the level of care assessment? Write the answers on 1 page and attach them to your binder's front pocket. 2 caution flags to end on. First, don't assume assisted living equals Medicaid later. Confirm the exact program that serves that building, the slot availability, and how your income and cost share will work. Second, don't skip the QIT just because your agent can move money. The QIT isn't about access, it's about legal routing of income to meet the cap rules. Get the trust drafted with the right language, open the account, and automate deposits. Once you map the right program, your spend down, account structure, and documentation fall into place. Protecting the healthy spouse without breaking rules. If one spouse needs long-term care, the goal isn't to impoverish the other. Medicaid actually has built-in protections for the community spouse, the one who stays at home. The trick is using those protections correctly, on time, and with clean records so you keep assets and income where the law allows without tripping eligibility. Here's the big picture. On the day one spouse enters a nursing home for a continuous stay, the state takes a snapshot of combined countable assets. That date drives the resource assessment. From that total, the community spouse gets to keep a portion called the Community Spouse Resource Allowance, or CSRA, up to your state's maximum. The rest has to be spent down appropriately before Medicaid starts paying for the nursing home spouse. Most people miss the snapshot timing and rush to move assets around. You don't need to panic transfer before the assessment. In fact, hasty moves create look-back problems. The resource assessment looks at both spouses' countable assets as of the snapshot. After that, you can reposition to get the community spouse up to the allowed CSRA using permitted transfers between spouses. Now let's talk income. Once the nursing home spouse is eligible, most of their monthly income goes to the facility as the patient pay amount. But the community spouse has an income floor, the minimum monthly maintenance needs allowance, or MMMNA. If the community spouse's income is below that floor, the rules let you divert a portion of the institutionalized spouse's income to the community spouse. That's an income shift, and it can be the difference between keeping the lights on and scrambling. The thing most people miss is how the CSRA and MMMNA interact. Assets determine the CSRA. Income determines whether you can shift money under MMMNA. Don't confuse asset transfers with income allocation. You might be allowed to keep more assets and still qualify for an income diversion. Each has its own calculation and paperwork. What about just putting everything in the community spouse's name? Name-on-title myths cause denials. Medicaid counts spousal assets regardless of which name is on the account up to the snapshot and assessment. Retitling to the community spouse after the snapshot is part of the normal process to consolidate the CSRA, but it doesn't make assets disappear for eligibility. It just aligns ownership with the allowed amount. In some states, there's another tool called spousal refusal. The community spouse can legally refuse to support the institutionalized spouse, which can move the case forward. States that allow it may still pursue support from the refusing spouse later, but it can secure eligibility in the short term. This is a legal strategy. Don't try it without counsel who knows your state's posture and the local fair hearing landscape. Fair hearings exist for a reason. If your CSRA calculation seems off, or the state underestimates necessary income for the community spouse's housing and utilities, you can appeal. Strong documentation, mortgage or rent, taxes, insurance, utilities, medical premiums, supports a higher allowance in some cases. The hearing is where clean records and a clear budget can increase what the community spouse keeps each month. Annuities enter the picture here, but tread carefully. In some states, a properly structured immediate annuity for the community spouse, single premium, irrevocable, non-assignable, actuarially sound, and naming the state as remainder beneficiary in certain positions, can convert countable assets into an income stream for the community spouse. Get this wrong term, assignability, deferred products, and you've created a transfer penalty or a countable resource. Get it right and you stabilize monthly income. This is attorney and state specific. Don't buy anything at a bank counter. Let me show you a clean sequence that protects the community spouse. Step 1, identify the snapshot date and pull a complete list of countable assets as of that day. Step 2, get the resource assessment from the state to set the CSRA. Step 3. Consolidate the CSRA into the community spouse's sole accounts, checking savings and CDs, while spending down excess in compliant ways for the institutionalized spouse. Step 4. If the community spouse's income is below the MMMNA, prepare the income diversion calculation and gather bills that support a higher allowance if applicable. Step 5. Consider state-approved spousal strategies like a compliant annuity only with counsel. Common mistakes to avoid. Moving assets to adult children instead of to the community spouse, those are gifts and trigger penalties. Leaving money co-owned with kids creates joint account problems and look-back risk. Paying the community spouse's expenses directly from the institutionalized spouse's accounts after eligibility. Those dollars often belong in the patient pay unless diverted under MMMNA. Mixing funds post-eligibility. Keep clear, separate accounts so the paper trail supports the allowance and cost share. Quick win: schedule a snapshot day review now even if you're only considering facility care. List every account, owner, and balance. Note which assets are exempt: home, one car, and which are countable. Build a simple budget for the community spouse with housing, utilities, food, transportation, insurance, and medical expenses. That budget becomes the backbone of your MMMNA argument if you need it. If your state allows spousal refusal or has generous fair hearing outcomes, talk to local counsel early. Tiny wording issues in annuities, beneficiary designations, or POA powers can swing thousands of dollars a month in the community spouse's favor or against you. Keep every letter, assessment, and calculation sheet in your binder and verify that your account titles match the plan. CSRA assets in the community spouse's single-owner accounts. Facility spouse down to the asset limit with patient pay tracked and no joint accounts with kids. If you remember nothing else, remember this: your spouse doesn't have to go broke. Use the snapshot to set the CSRA, use MMMNA to protect income, and use state-specific tools carefully. Clean math and clean records are what keep the healthy spouse safe. Paying bills without joint ownership, practical tools. Convenience is the reason people add joint owners, and it's the reason they get denied. You can keep the convenience without the risk by separating access from ownership. The goal is simple: you stay the only owner while trusted helpers get the right visibility and the right controls to pay bills safely. Start with view-only access. Most banks let you create online credentials that can see balances, statements, and cleared checks but can't move money. Give this to a child or helper so they can monitor due dates, spot fraud, and keep the binder up to date. Visibility prevents oops transfers because watchers aren't doers. Next, use online bill pay aggressively. Set up payees for utilities, insurance, taxes, medical providers, and recurring services. Your helper acting under your durable POA can schedule payments without becoming an owner. Bill pay creates perfect paper trails: who, when, how much, and for what, right on the statement with payee names that make sense to reviewers. Now add a controlled debit card for the agent. Ask your bank for a second debit card on your single-owner account, issued in your name with agent for the POA holder. Set daily and per transaction limits. Turn on text alerts for transactions over a threshold and for card-not-present purchases. If your bank supports geofencing or merchant category controls, enable them. Groceries and pharmacies allowed, cash withdrawals blocked. You keep control, your agent gets tools, and your statements become clean evidence. For larger or irregular expenses, use checks with disciplined memos. The agent under the POA writes home care 18 HRS at 22/HR, 6/10/6/14 log P4 or dental crown in 5849. Checks beat cash every time because the images store in online banking. That's built-in documentation for your binder without hunting later. Set account alerts like a hawk. Turn on low balance alerts, large withdrawal alerts, new payee alerts, and failed login alerts. Send them to both you and your agent. Add monthly statement reminders so nothing slips. If your bank offers card controls in the app, the agent can lock and unlock the card as needed, which reduces fraud risk and proves intent to keep funds safe. Use separate lanes for different money types. If you have a Social Security representative payee, put those benefits into a dedicated rep payee account titled correctly. Pay allowable expenses from that lane and keep the annual reports. For general expenses, use your operating checking. For savings, keep a single-owner savings with limited transfers and no debit card attached. Clear lanes simplify eligibility reviews and prevent accidental commingling. Avoid shared credit cards with helpers. Instead, add the agent as an authorized user with a very low limit on a card in your name and use it only for your expenses. Pay that card from your operating account, or skip cards and run everything through bill pay and checks. The fewer instruments you use, the fewer places mistakes can happen. Cash apps can work with discipline. If you must use Zelle or Venmo, standardize your note language. Reimbursement RX 611 receipts 310-314, caregiving 10 HRS at $22 612 log P5. Immediately screenshot receipts in the transfer and save them in your digital folder. Better, use bill pay or checks so documentation happens automatically. Build dual approvals for big moves. Some banks and bill pay platforms let you require 2 approvals for transfers over a set amount. You create the payment, your agent approves, or vice versa. That adds friction where you want it: large, unusual payments while keeping routine bills easy. Do a 20-minute banking settings audit today. Open your online banking and enable view-only access for a watcher, activate alerts, issue an agent debit card with limits, disable ATM withdrawals on that card, turn on check image storage, unlock international and card-not-present transactions unless needed. Then list every automatic bill and confirm payees and amounts are current with clear memo descriptions. Common mistakes to avoid: don't give your PIN to anyone. Don't let a helper deposit your funds into their account to pay bills faster. Don't add a child as a joint owner just to see the account. Don't leave old autopays tied to a child's email or address. And don't keep multiple small accounts with mixed labels. Consolidation improves clarity. If you remember nothing else, remember this: let people see what's happening, let them pay bills through your authority, but never let them become owners. Single owner structure plus controlled tools equals convenience without penalties. That's how you stay Medicaid-ready and keep life running smoothly. Case studies: from risky to Medicaid-ready. Seeing the map makes it easier to act fast. Let's walk 3 real-world scenarios, then I'll hand you a checklist you can use today. Case 1: widow with adult child on the account. Mary had 2 accounts, a $22,000 checking titled Mary and Susan JTWROS, and a $9,500 savings labeled Pod Susan. On statements, we saw Zelle payments to Susan with pizza emojis and $400 cash withdrawals every month. That's denial bait. We moved fast. Step 1: opened a new single-owner operating account in Mary's name only. Step 2: used her durable POA to set up online bill pay and view-only access for Susan. Step 3: closed the joint account after all auto pays migrated. Any remaining balance moved to the new account with a memo. Consolidation from prior account, single owner. Step 4: stopped Zelle and cash for reimbursements and replaced them with checks that matched receipts. We built a reimbursement log and stapled receipts to each check image. Step 5: the pod savings stayed in Mary's name for eligibility. We labeled it in big letters, Countable for Medicaid estate tool only, so nobody confused it for protection. We also funded an irrevocable funeral contract with a portion of savings within state limits and filed the contract. Result: clean single-owner structure, documented reimbursements, and no more joint ownership or sloppy memos. On review, the caseworker could tie every dollar to Mary's needs. Approval followed. Case 2: married couple with spend down, spousal protection, and a QIT. Frank entered a nursing home in March. Martha remained at home. Snapshot day showed $168,000 in combined countable assets. Their state CSRA max was higher than half, so Martha could keep up to the maximum allowed. The rest had to be spent down for Frank's eligibility. We consolidated Martha's CSRA into her single-owner checking and CDs. The excess went to targeted spend down, dental work and hearing aids for Frank, a stair lift at home so Martha could get him upstairs safely during visits, 6 weeks of documented private home care before long-term placement, and repairs on the exempt car. Income was just over the state's waiver cap, so we drafted a qualified income trust with the state's template, opened a QIT bank account, and set automatic deposits of Frank's pension on the 1st of each month. We labeled every QIT transaction and kept monthly statements behind the trust document. For income protection, we calculated the MMNA for Martha and prepared the diversion request with her mortgage, tax, insurance, and utility bills. Patient pay for Frank was then reduced by the allowed diversion. Result: Martha kept the CSRA in her own accounts, stabilized her monthly income, and Frank qualified with the QIT handling income over the cap. Clean titles, clean math, clean approval. Case 3: sibling helper switched to POA and cure past payments. Alina added her brother Louis to her account to help. Over 2 years, he used the debit card for mixed errands, gas, groceries, and sometimes his own expenses when cash was tight, intending to settle up later. The statements were a mess: round withdrawals, generic point-of-sale transactions, and random Venmo transfers. We unwound it. First, removed Louis as a joint owner and executed a durable POA naming him as agent. Second, opened a fresh single-owner operating account and routed all income there. Third, we did a look-back audit, flagged every person-to-person payment and cash withdrawal in the past 36 months. Where expenses clearly benefited Alina, we traced receipts and wrote a one-page index mapping each transaction to proof. Where Louis had used funds for himself, he returned what he could over 3 months. Each deposit carried a memo return of prior transfer cures. For the unrecoverable portion, we documented hardship and immediately formalized a caregiver agreement at market rate with time logs going forward, so new payments were compliant. Result: partial cures reduced the penalty calculation, the forward-looking pattern turned clean, and the application moved with an honest, documented story. Micro story: Frank and Martha redo $200K protected via compliant structure. Different couple, same names for simplicity. They had $320,000 countable when he entered care. Their state allowed a higher CSRA with fair hearing evidence. We documented Martha's real housing and medical costs, won an increased CSRA, and used a compliant immediate annuity for part of her share, irrevocable, non-assignable, actuarially sound, with proper state beneficiary language, converting assets into protected income. We spent down the rest on Frank's dental, vision, equipment, and a prepaid funeral. End state: roughly $200,000 effectively protected for Martha's lifetime needs without a single transfer to kids, no joint titles with children, and a straightforward approval. Now your quick action checklist: accounts to close, forms to file, records to save. Close or convert any JTWROS or joint accounts with non-spouses, any account with odd labels like ITF that causes confusion, duplicate small accounts that complicate reviews. File updated durable POA with explicit banking and government benefit powers. QIT documents if your program requires it with a dedicated bank account. Representative payee paperwork if Social Security needs it. Irrevocable funeral contract with itemization. Save 60 months of statements for all active accounts, check images, invoices and receipts, caregiver agreements and weekly logs, transportation mileage logs, insurance and tax bills, and any documents supporting spousal allowances. Run this sequence and your messy picture becomes Medicaid-ready. Single owner control, lawful authority, documented spending, and titles that match the plan. Red flags that trigger audits and denials. After you clean structure and records, avoid patterns that scream gift or hidden control. Reviewers look for signals, not excuses. If they see these, they dig deeper and deny faster. Round number cash withdrawals are the loudest siren. Repeated $200, $300, $500 ATM pulls with no receipts look like gifts. Shift those expenses to checks or bill pay, and if you need cash for specific items, keep itemized receipts that total to the withdrawal and file them together. Frequent person-to-person transfers to family without matching documentation get flagged. 10 Zells to a child with emojis and vague notes read as support, not reimbursement. Every transfer to a person needs purpose, period, amount, and proof. Money moving in circles is another red flag. Funds out to a relative, then back, then out again. That can look like parking assets. If you're curring a transfer, make the return once, label it return of prior transfer cures, and stop the ping pong. Shared spending from joint accounts, even for convenience, invites scrutiny. If a non-spouse can withdraw, Medicaid assumes availability and often gifting when those funds benefit the other owner. Retitle to single owner and route all reimbursements through documented checks. Cash app opacity hurts. Venmo or Zelle with thanks isn't proof. Use descriptive notes and attach screenshots of receipts to your digital folder. Better yet, pay providers directly so the statement carries the payee's name. Vague memos are a quiet killer. Help, support, loan, gift, family invite denials. Replace with specifics. Caregiving 12 HRS at 22/HR7/27/4 log P1 RAIM RX receipts 410-416 PT copay in 5842. Backdated documents get rejected. A care agreement signed today cannot retroactively justify last year's payments. Start agreements now, keep logs, and stop non-compliant patterns immediately. Big, sudden changes right before application, closing accounts, moving funds, buying multiple items in a week look like cleanup maneuvers. Start early, spread legitimate spend down across cycles, and narrate big items with invoices and brief notes. Unusual deposits from family can also raise questions. If a child pays back sporadic amounts but you lack the original transfer trail, that can look like commingling. When curring, tie the deposit to the specific prior transfer with dates and amounts. Here's your monthly red flag scan and fixes. Scan statements for round number cash pulls, person-to-person payments, and transfers without named payees. Fix in 3 moves: convert cash to checks or bill pay, add precise memos and attach proofs, and if needed, pause app payments until documentation catches up. Do this every month, write a 1-paragraph cover note, and your file reads clean. If you remember nothing else, specific beats vague, provider names beat people, and paper beats memory. That's how you avoid audits. The next step. The core rule is simple. Keep single owner control, document every dollar, and make your spending clearly serve your care. Now act. Pull your latest statements, close risky joint setups, enable POA tools, and start your Medicaid-Ready binder today. For your next move, watch my deep dive on spend down strategies and caregiver agreements so you lock this in fast.